Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for February 8th of 2026. We will get started on the chart pack this week with a little bit of data on inflation. So we're sitting here, about 3 months ahead of the change in command at the Federal Reserve, and a lot of to-do has been made over where interest rates are going to go under Fed Chairman Warsh, and that is obviously presuming that he will be confirmed, which is almost a certainty. But Kevin Warsh has long advocated for higher rates and taken a very hawkish tone in his tenure during his tenure as a Fed governor and in many speeches therein. Now, more recently, though, he's taken a very dovish tone, and which I think, as we all would suspect under the Trump administration, would be required for a new Fed chair. And so, as we sit here, 3 months away from that transition, we want to take stock of where inflation is now, because what we don't want to have, and this is the risk, this is a policy risk as we look into the second half of the year, that you get a lagged effect of lower interest rates on inflation. Lower interest rate meaning that you're stimulating the economy, you're providing easier credit. That in turn is helping to overstimulate the economy, which, when you have too much money chasing too few goods, that results in textbook inflation, and that usually comes at a lag of anywhere between 6 and 9 months. So again, I think the spirit of this is wanting to take a look at where inflation seems to be heading now. And we'll start with this chart here. So we have in the green line, we have average hourly earnings. And as we've noted over many quarters now, that is in a distinctive downturn. And you can see that this is not quite linear, but it's very pronounced. And then in this amber line, we have the Fed wage survey indicator that is being led by 6 months. So it's a leading indicator. And so you can see that this also has trended down. And, there's a reasonable amount of correlation in the sense that these, outside of the pandemic here, have kind of moved together, whether they're moving up or down. But this is notably turned up over a handful of months now. And so, this is leading people to think that, okay, that earnings have, the downtrend in earnings may be stalling out. Now, we do know that labor is a little bit weaker. So again, this is just but one of many indicators that I think are, we're trying to draw some conclusions from, because, when you think about the stickiest components of inflation, wages are right up there with rents, which we've talked about also. But again, not saying that this is, going to be a, very tight correlation and we're going to have this long-term lagged effect of wages. Good news is that wages are still ahead of inflation, so real wages are still positive, which is good for consumption and consumer spending. Another risk to inflation, we have industrial commodity prices, again, on a lead by 6 months. You can see here in the green line, that is the commodity prices, and we're already moving up ahead of the tariff regime that went into place earlier last year, I should say. So that's moving higher. Now, against that, you've got consumer price index, CPI, inflation, which, as we know, is been a little sluggish to maybe down, kind of stuck in that 3% range. And so, when you take stock of the leading nature of this, it may draw the conclusion that you're going to get higher overall inflation. So I think it's not a certainty, just as it wasn't a certainty in the prior chart. However, these are things that we need to take stock of. If we're going to stimulate the economy more than it is now, then we have to take stock of these risks. Here we have dollar depreciation, and this is a very interesting chart where correlation is certainly positive. It's not terribly tight, but it is positive. You can see here that you've got the dollar index. This is inverted. So we know that the dollar has been very weak. So the fact that we've had this kind of pronounced rise is symptomatic of a dramatically weaker dollar than we had a year ago, and that is absolutely the case. So, but when the dollar weakens as it is now, you tend to see, CPI move kind of hand in hand. So again, positive relationship here between these data points, and sometimes it doesn't always work in kind of quote unquote real time. But the risk is that you get CPI inflation that's moving higher in tandem with the weaker dollar. Here we have the Institute for Supply Management Services Purchasing Managers Index. So it's a lot to swallow right there, but the ISM PMI, Purchasing Managers Index, here, at least from a services standpoint, of course, they also release the manufacturing PMI, but services remains in positive territory. We look at new orders, maybe off their peak, but again, still solidly positive. That's a good sign. Here we have employment, which we know has been rather sluggish, in fact, negative and in contraction mode for some period of time. We did have a little bit of a green shoot there when it went positive, and now it's pretty much flat. So really just emblematic of just a sluggish employment sector. And I think also too, maybe from a services side, we're getting a little bit of productivity out of AI, but a little bit hard to tell at this juncture. Prices index maybe off its interim peak here, little uptick here. Clearly, you look at the last year, it's above where it was in 2024 when we were coming off that major inflation that was sparked after the pandemic. So, geopolitical ramifications tend to not have an outsized impact long term, especially on the investment markets. But it is important to realize the saber rattling that's going on right now. And we really, haven't talked a lot about, mentions in the press about, Iran, about Gaza, really even about Ukraine. But having said that, we've got Iran and Gaza daily story count, just kind of really muted. Iran's gone up lately because there has been more saber rattling and a potential attack, and we're moving military assets to the Persian Gulf. And so, again, the rhetoric's picking up a little bit, and that's manifested here. And then you look at energy prices, and that has had an impact. And that's usually what happens is you get a short-term kind of dislocation. You've got traders trying to make sense of it, and you've got people trying to rush, at least from a supply and demand side, to try to get out in front of any potential supply disruptions. And so you see the Brent crude prices have moved up higher, and we've seen a pretty good response positively out of the energy stocks as well. And you can see it popped right through that 200-day moving average. Well, and if you want to talk about oil prices and have a little bit of a history lesson, I thought this chart would be really good for that, because this goes back and it basically indexes the cost of West Texas Intermediate crude going back to 1989 in this blue line. So this is basically the impact of the Iraqi invasion. So you're taking Iraqi oil offline. There's a risk of kind of a regional conflict. So this is going way back into the archives here, and you can see that on an index level, from June 20th of 1989, we went from 100 to like 250 on this index, and that was a dramatic rise. And we haven't seen anything like that. This black line is indexed back to December 17th of 2024, and you can see, if nothing else, we've gone down. And so, if things pick up a little bit here because of some headlines related to Iran, that's obviously positive. But let's put this into context here. It wasn't anything like the Iraqi invasion and what happened there, and the kind of the ensuing recession that we had as a result of that. Now we'll talk a little bit of China here. This is a chart that kind of shows you the evolution of trade between these two countries in a little bit, and basically, point out, you can see this in this data over here, that China or Chinese exports going to the U.S. Has basically been cut in half as a percent of the total. So here we have some data related to commercial lending. And so this is in the blue line, we have the net percentage of respondents reporting tightening conditions for large and medium sized companies. So you can see here some net easing in that area. In the latest report here that we got for small firms, which is in this amber line, was a little bit of an uptick. So say by and large, you can see that over several months that the credit standards or the lending standards have gotten a little bit easier on both categories, but the most recent uptick here makes credit a little bit tighter for the small companies. Here we have distribution of household wealth, very interesting demographic. Basically you've got baby boomers that still hold $88 trillion of wealth. And when we talk about the great wealth transfer that's coming in the next 20, 25 years, this is it. And so you see Gen Xers moving up the food chain. You can see how this is all evolved by generation. And you've got silent generation, about $21 trillion. But this is where all the movement's going to happen here in the next probably say 15 years, and then the next 25 years, you're going to have much more of this wealth transferred down to these two categories here. Quick labor comment here, something we've been following for quite some time. We know the labor market is slowing down, not a surprise there. We've got job openings here, and the last reading that we got was for the December period, and that was below expectations. We got basically 6.5 million job openings. You can see that that's been in decline for a while. And this was a notable downtick here. So again, labor market's slowing. Over on the right, we actually have a ratio of job openings, the number of job openings to the number of unemployed persons. And so this ratio has also been declining as well. So we know that basically both job openings and unemployment has picked up. And so that contributes to the magnitude of this decline here. So this is a chart I've been talking off of for a little while. This is kind of basically the source of gold. I know I showed this a couple weeks ago, but I still think it's pretty interesting in light of the gyrations in gold. So we had a fairly big correction in gold prices, as we did silver, palladium, all the metals corrected here lately. And I'd say that silver was in the biggest bubble and had the biggest correction. But gold has since rebounded, and you can see here the different sources of supply here. So we've got basically bars and coins, gold coins, including gold-backed exchange-traded funds. It's about 23%. Obviously, we talked a lot about how central banks have ramped up their holdings of gold. In fact, foreign central banks have increased their gold holdings and have, in absolute terms, have dropped their holdings of U.S. Treasuries. But very interestingly enough, you got this jewelry category here, and this is like 45% of total supply of gold is in this form right now, and held largely in a private sector. And again, very much a global phenomenon there. So we start talking about stock market here. We've got the number of stocks within the S&P 500 that are outperforming the broader index. You can see that we've had a lot more breadth this year. We've got 300 out of the 500 stocks that are outperforming the index. So you can see that that number has been fairly static in the 3 previous years. So we're getting a lot more breadth in the market this year. Here we've got technology stocks. You can see that technology actually went into correction here recently. And so, we've been dealing with these daily kind of sell-offs in the market, and the market's just been really sloppy, really since the start of February here. But you can see that technology kind of reached its interim peak right at the end of last year, and it's just been weak ever since. And, as we just saw, we've got a greater percentage of stocks that are outperforming the index, and we can see here clearly that it's a good thing. It's very healthy for the market to have more breadth, even if we see technology down 10%. There's tech versus S&P 500, the forward price to earnings ratio. At one point we were talking like, 27, 28, 29 times forward earnings for technology. That sell-off that we just spoke of brought that number down to roughly about 24. So again, I wouldn't say that tech is cheap by any stretch. The broader market sell-off took the index forward price to earnings ratio down to 21.6. Again, that's above long-term averages in both cases, but at least healthier in the sense that we're getting a little bit closer to more equitable pricing. Earnings have been a source of conversation here over the last several weeks, and what we're finding here is that the revenue beat rate, again, this data goes all the way back to 2003, but usually you see the companies beat the analyst expectations for earnings and revenue. You see that the average here is, I'd say, probably closer to about 70% on earnings, and maybe something that feels a little bit more like 60, 65% on revenue. And again, I'd say that we had a bunch of positive surprises in the last quarter, and that seems to be reversing this quarter. But I would say, the beat rate is still, at a level that gives you some room for optimism as you look out over the next couple of quarters. And this is a market, even with this sell-off, that I think earnings have to be good for this market to continue to move. And right now, we're looking for anywhere between 14 to 16% earnings growth this year. And I'm a natural skeptic. I think even if you get 8 to 10, that's a win. But again, those estimates may be a little bit high. But I think analysts have been doing a reasonably good job over a period of years now of kind of at least undershooting what actual performance is. On this slide, we have basically an earnings progression. These are aggregate earnings. And just to differentiate, the last slide we were talking about forward price to earnings per share for the cap-weighted index, for what you read and the index levels that you see in the news. Well, the equal weighted index is also very important because, as we know, the equal weighted index has underperformed up until recently the cap weighted because of those Mag 7 stocks. But with that having turned around, I think it's really healthy to look at the level of earnings for the equal weighted index. And you can see here very clearly that that's moving higher. And we've had not quite a linear progression, but we've had some acceleration here over the last year in equal weighted. So again, it's not just the technology stocks, it's not just the hyperscalers that are outperforming in earnings. We have a broader set of the remaining stocks in the index that have actually done quite well in addition to that. Something else I thought was interesting here is, looking at the U.S. versus the international backdrop, and we do this on occasion in various ways of comparison here, but you can see forward earnings per share that's indexed to 2009. You can see the U.S. has done much better than the rest of the world. I mean, both are moving higher. We do know that international did extremely well as a sub asset class in terms of price appreciation last year, and they are also witnessing EPS growth, but not the level of earnings growth that we've seen here in the U.S. And then sliding over here, this is what the analysts are expecting. And so, we've long advocated for diversification to international, even though, the rate of earnings growth has been lower. But we do see here that the long-term earnings growth estimates are moving higher for both the U.S. and the rest of the world outside of the U.S. And that's, I think, very helpful to the exposure that we have, that diversified exposure, and obviously helpful to overall portfolio growth going forward. We're talking about the Magnificent Seven, and here's kind of a summary of where we are with those stocks, and we do know that that they did well for the most part over the last year, but not all of them outperformed the index, and yeah, there were certainly other sectors that really began to take the lead in the market. And so what we see here is we've got basically the 200-day moving average. This is a long-term moving average, and you can see that with that tech correction, really at play here, that we've seen a pretty big drop in these Magnificent Seven stocks to the point where they have passed through that moving average, which you go back here when it passed through, it was a relatively short-term phenomenon. Sometimes the technical indicators, if you break through that moving average, you tend to languish below your moving average for a while. That obviously didn't happen here. But again, this is like, I think, all part of this rotation of sorts into the broader market, which I think if you're looking ahead and expecting further market gains for at least the first half of the year, then this is actually not an unhealthy development in light of the fact that you're seeing other sectors really take the lead, like energy, for example. Net profit margin has been somewhat of a phenomenon here. You can see that we going back to 2021, that we did have really at that point peak margins around 13%. Well, we eclipsed that in the third quarter, and we're expected to move one notch higher, basically 10 basis points higher there in the final chapter here of 2025. But these margins are really helping to propel earnings, of course. It's really a cause and effect kind of a thing, but and it's really helping to propel the rate of growth that we're seeing too, because not only are you getting like increased sales, which dollar for dollar you're getting extra profit, but you're actually getting more operating leverage as these profit margins are moving higher, which I would argue is a bit of a surprise considering that you've got higher production input costs, as we saw very early on in the chart pack, due to tariffs that in many cases those are being passed along to final consumers, and that's allowing these margins to continue to increase. Well, now we have the other side of the coin. Stocks have been doing well, a little bit of a pause in the market here recently, but Bitcoin as a speculative investment has really taken it hard. And you can see here, at one point Bitcoin was around $120,000. It's now basically half that. And this is the danger when you go from basically about September, October, in the span of 3 months, that you can lose 50% of the value. And this is one of the big reasons why it's difficult to include Bitcoin in diversified portfolios to any measure, because it does have such wild swings. And there are times where Bitcoin is actually very highly correlated to equities. But the sell-off has been very, very intense. And you can see in this fear and greed index with 100-day moving average here, that there is a tremendous amount of fear in the crypto market right now. Treasury yield curve here. This is the 2-year Treasury versus the 10-year Treasury, and the gap between those two yields. And this is the highest, most steeply sloping yield curve that we've seen since 2022. And you can see that the yield curve, after having compressed and actually gone inverted in 2023, which again was a time we thought we were going to have a recession, and we did not. But ever since that trough here, the yield curve has been steepening in a way that honestly, has dovetailed oddly rather nicely with a rising equity market. So you think about yields moving higher, and this is a function of both the long end of the curve moving a little bit higher, as well as the short end of the curve moving lower because of the interest rate cuts by the Fed. Couple of energy notes here. We've got natural gas inventories, which not too surprisingly have really gone down. We had a lot of cold weather, and in fact, parts of the country, certainly not in Texas, but parts of the country are still in a very deep freeze. And so we see natural gas inventories go down for quite a bit for, as usage has really spiked because of the need to heat homes. Here we have some data on the oil industry. What I find very, very interesting here is we've got crude stocks. We've been talking, for a while now about weak crude prices, but as we just saw, Brent crude, moving higher, oil prices moving higher, energy stocks all moving higher. We've got a 4-week moving average of stocks that are going down. And then, then I dovetail this because I thought this was an interesting conversation that probably begs for more time than basically the minute or so that we have in the chart pack here. But the Dallas Fed, has made done some analysis that says that if you're less than $65 a barrel in WTI or West Texas Intermediate, which again is within striking distance of where we are now, that it is less profitable. Returns are not as much, so you get less capital spending. So what this tells you is that you got these stocks dropping, you got prices beginning to stabilize. We've had this capital spending decline, the rhetorical question embedded in this chart here is whether some inventory reductions and price improvements are going to maybe stimulate incremental demand. So private markets, this represents private credit and private equity markets. This is dry capital. So you've got a lot of funds that have raised money and they're looking to deploy it. Usually they're having to pay shareholders like something like an 8 or 10% preferred carry, which just means that they get paid basically 8 to 10% on their money until they actually deploy it, and then obviously the returns come from the investments. But you can see that over the last handful of years that we've got private market funds that have raised a tremendous amount of dry powder. And I think that could lead to a lot of M&A activity. It could lead to a lot of additional credit activity as like non-banks, but very strong capital position for those private players right now. And we'll end on a couple of interesting notes. We've got capital spending for really the hyperscalers here, and this is as a percent of gross domestic product. So this is basically spending as a percent of the total economy in the United States. And for these hyperscalers, it's 2%. And this Wall Street Journal article, which I thought was very interesting, kind of mapped this against other major spending programs. And you think about the rail industry back in the 1800s really on the eve of the Civil War here, they spent about 2% of the national economy on that. What's interesting, and I thought this would be more, is the interstate highway system only accounted for about 0.4% of the total economy back in the late 50s and 60s. And then the Apollo space program was a little bit less than that. But then again, if you go way back to 1803, all you history buffs out there, we spent a whopping 3% of our total national economy, which at that point, having only spent basically 12 billion for the Louisiana Purchase, you could tell it was obviously a much smaller economy, but bigger in its magnitude. But suffice it to say, the hyperscalers are spending a lot of money on this, and I think that's calling into question now, is that going to be productive spending? Are they getting out in front of their skis too much and overdeveloping before the demand really kind of kicks in? And a lot of speculators are getting in the, development speculators are getting in this, because as we just saw, capital is getting a little bit easier to get, and people want to be out in front of this whole, AI spend deal. And so, not surprising, we're seeing a lot of spending, but that's also bringing into play some speculation that it might be a little bit ahead of itself. And then here we're going to end on this slide. So this is, again, circling back to China. Just as we talk about international investing being a good place to be and the virtues of diversification, what really still kind of gnaws at me a little bit is, and I chuckle at this, that China is still listed in the emerging markets category, and the second largest economy in the world is still quote unquote an emerging economy. But what this chart tells me is that the law of large numbers is beginning to kick in. So for many years after, China won its inclusion into the World Trade Organization, we had these big growth years. I mean, much better than the official targets by the Communist Party Central Planning Committee. And then that began to change. Last decade, you could see some downtick in overall annual growth. Forget about the dislocations here in the pandemic, but you had very weak growth for in a couple of years. This was a bounce back from that year. But again, you see this migrating down to 4%, which is a sign of a bit of a mature economy to have these rates of growth decline over time. And so, for years we talked about how China was really the engine of global growth, and that Chinese growth accounted for, a majority percentage of overall global growth. Well, that is changing. And what this means for global growth is that you're going to have more of the rest of the world kind of pick up the slack. That's all we have for this week. Hope you've enjoyed the chart pack. Have a great week, and we'll talk to you again soon.